It's Monday, January 19th, 2026, and what I'm about to tell you is going to completely change how you understand what's happening in the silver market at this very moment. I'm William Lee, and for the last 48 hours, I've been watching something that most people won't fully comprehend until it's already too late to act. Right now, as I'm recording this, silver is trading at approximately $94 to $95 per ounce. But here's what you need to understand. This isn't just another rally. This isn't just another squeeze attempt that's going to fizzle out like we've seen dozens of times before. What we're witnessing right now is the complete and total breakdown of the global silver distribution system. And the price you're seeing on your screen is just the beginning of what's about to unfold. Let me start with what happened in the last 24 hours, because this is absolutely critical. When the futures markets opened Sunday night, we didn't see a gradual climb. We didn't see cautious buying. We saw a gap up that sent shockwaves through every single trading desk from New York to London to Tokyo. Silver blasted through every resistance level that analysts said would take weeks to breach. And here's where it gets absolutely insane. The price didn't just gap up and then consolidate, it kept climbing. It liquidated every single bearish position that was sitting below the current price levels, and it did so with a violence and speed that I haven't seen in over a decade of watching this market. What we're seeing right now is what I call a liquidation cascade combined with an unstoppable bullish trend. Think of it like this. Imagine you're standing at the bottom of a hill and there's a massive boulder at the top. For years, that boulder has been held in place by ropes and stakes. Those ropes represent the short positions, the paper contracts, the suppression mechanisms that the banks have used to keep silver prices contained. Well, yesterday someone cut the ropes, and now that boulder is rolling downhill and it's picking up speed with every passing hour. The bearish positions below the current price, they're gone, liquidated, wiped out. The traders who were betting on silver falling back to $85 or $80 got margin calls. They got forced out, and when they got forced out, they had to buy back their positions, which pushed the price even higher, which triggered more margin calls, which forced more liquidations. It's a self-reinforcing cycle, and right now there's nothing standing in the way of this momentum except the next layer of resistance, which is sitting somewhere around $100. But before we talk about where this is going, I need to take you back 24 hours to explain exactly how we got here, because what happened over this weekend is not just a price movement. It's a fundamental restructuring of how silver flows around the world, and if you don't understand the mechanics of what just changed, you're going to be caught completely off guard by what happens next. Let me paint you the picture of what Sunday looked like. While most people were enjoying their weekend completely oblivious to what was brewing, something happened that changed the entire game. President Trump announced a 10% tariff on imports from 8 European nations, plus the United Kingdom, starting February 1st. That's less than 2 weeks away. And buried in that announcement was a sentence that most people glossed over, but that sent the risk managers at every major bullion bank into absolute panic mode. The United Kingdom is on that tariff list, and the United Kingdom is home to the LBMA, the London Bullion Market Association, which is the single most important physical silver trading hub on the planet outside of New York. Let me explain to you what this means in practical terms, because this is where most people get completely lost. Imagine you have 2 water tanks. One tank is in New York and it's currently full of water. The other tank is in London and it's almost completely empty. Under normal circumstances, this wouldn't be a problem. You'd just connect a pipe between the 2 tanks and the water would flow from the full tank to the empty tank until they balanced out. That's how the global silver market has worked for decades. When London runs short of physical silver, which has been happening with increasing frequency because of massive demand from India and China, the bullion banks simply move silver from the COMEX vaults in New York to the LBMA vaults in London. They put the metal on planes, they fly it across the Atlantic, problem solved. The tanks stay balanced, the market stays liquid, everyone's happy. But here's what just changed. President Trump just put a 10% tax on the pipe connecting those 2 tanks. And if a deal on Greenland isn't reached by June 1st, that tax jumps to 25%. Now you might be thinking, okay, so they pay a 10% tax, big deal, they can afford it. But that's not how it works. Let me explain the trap that just snapped shut. If a bullion bank ships silver from New York to London right now, they can do that without paying an export tax. The silver leaves the United States freely. But here's the catch. When they need to bring that silver back to New York later, which they absolutely will need to do because the COMEX also has delivery obligations, they have to pay a 10% tariff on the value of that metal when it comes back into the United States. Let me give you a concrete example so you can see exactly how devastating this is. Let's say silver is trading at $90 per ounce. A bullion bank needs to ship 1 million ounces from New York to London to cover a short position. That's $90 million worth of silver. They ship it, no problem. The metal arrives in London. They've solved their immediate crisis. But 3 months later, the COMEX runs short, and they need to bring that million ounces back to New York. Now, when that silver crosses back into the United States, they have to pay a 10% tariff. At $90 per ounce, that's $9 per ounce, which means they're paying $9 million in taxes just to get their own metal back. And if the tariff escalates to 25%, they're paying $22.50 per ounce, which is $22.5 million on that same shipment. In the razor-thin margin world of bullion banking, where profits are measured in pennies per ounce, paying $9 or $22.50 per ounce in tariffs doesn't just hurt. It makes the entire operation economically impossible. It's financial suicide. So what do the banks do? They stop moving the metal. They trap it in place. They refuse to ship silver from New York to London because they know they can never economically bring it back. This is what I call the Roach Motel effect. You know the old slogan, roaches check in, but they don't check out. Well, that's exactly what the United States bullion market has become. Silver checks into the US, but it doesn't check out. And this creates a catastrophic problem for the global silver market because London is now completely cut off from the single largest source of available physical silver. Now, here's where this gets really interesting, and this is the part that nobody in the mainstream media is talking about yet. In the first quarter of 2025, we saw one of the largest movements of silver from London to New York in modern history. Dozens of millions of ounces flowed out of LBMA vaults and into COMEX warehouses. And at the time, people thought the banks were being smart. They thought the banks were front-running the Section 232 review, which is the mechanism that the US government uses to determine if imports of a certain material threaten national security. Silver is obviously a strategic mineral. It's used in everything from solar panels to missile guidance systems to 5G infrastructure. Everyone knew that a Section 232 review was coming. Everyone knew that import restrictions were possible. So the banks did what they thought was the smart thing. They moved their silver into the United States ahead of time to avoid getting caught on the wrong side of import tariffs. But here's the beautiful irony that makes this entire situation so perfect. The banks assumed the tariffs would restrict imports into the United States. They moved the metal into US vaults, thinking they were protecting it. But they completely miscalculated. The tariff doesn't restrict imports. It restricts exports. Or more accurately, it makes exports economically suicidal because you can never bring the metal back without taking a massive loss. So the banks, in their attempt to be clever, in their attempt to front-run government policy, literally trapped themselves. They moved millions of ounces of silver into a cage and then locked the door from the inside. It's like a bank robber who breaks into a vault, stuffs his bag with money, and then realizes the only way out is through a door that costs him 25% of everything he's carrying to open. He's rich inside the vault and broke if he tries to leave. And this brings us to what's happening right now, today, January 19th, 2026, as silver trades at $94 to $95 and continues to climb. The market is starting to wake up to the reality of the trap. Let me walk you through what happened overnight and why this momentum is so unstoppable. When the futures markets opened Sunday night, the first thing that happened was a gap up. Silver didn't open at Friday's closing price, it opened significantly higher, and that gap immediately triggered stop losses on bearish positions. Traders who were betting on silver going down had stop loss orders sitting at certain price levels. When those levels got hit, their positions automatically closed, which meant they had to buy back their short contracts, which pushed the price higher. As the price pushed higher, it hit the next layer of stop losses, which triggered more automatic buying, which pushed the price even higher. This is what's called a short squeeze, and it's a self-reinforcing mechanism. The higher the price goes, the more bearish positions get liquidated, which pushes the price even higher, which liquidates even more positions. But here's what makes this particular squeeze different from every other squeeze we've seen in the last decade. In previous squeezes, the banks had a way to stop the bleeding. They could move physical metal from London to New York to meet delivery demands. They could lease silver from central banks. They could shuffle inventory around the global system to wherever the pressure was building. They had flexibility, they had tools, they had escape hatches. This time, all of those escape hatches are sealed shut. The tariff has eliminated their geographic flexibility. They can't move metal from New York to London without trapping it there permanently. They can't rebalance their global positions without taking catastrophic losses. And so the squeeze just keeps building pressure with no release valve. Think of it like a pressure cooker. Normally, when pressure builds up inside a pressure cooker, there's a little valve on top that releases steam. As long as that valve is working, the pressure never gets dangerous. But what happens if you weld that valve shut? The pressure keeps building and building, and eventually something has to give, the pot explodes. That's what we're watching right now in the silver market. The pressure is building, the bearish positions below $95 have been liquidated, and the next layer of resistance is sitting at $100. Once we break through $100, and I believe we will break through $100 this week, possibly in the next 48 hours, we're going to see another massive wave of liquidations because there are a lot of traders who have short positions with stop losses sitting right above the $100 level. They put their stops there because $100 is a psychological barrier. It's a big round number. It's a level that silver hasn't traded at in modern history, and they thought silver will never actually get to $100, so my stop is safe there. Well, they're about to learn a very expensive lesson about underestimating the power of a supply chain disruption combined with a technical short squeeze. Now, let me explain why this bullish trend is not just strong, but inevitable. And I'm using that word very deliberately, inevitable. Not probable, not likely, inevitable. Here's why. The fundamental driver of this move is not sentiment, it's not speculation, it's not retail investors piling into the market hoping to make a quick profit. The fundamental driver is a structural impossibility in the global supply chain. London needs physical silver. They have contracts that require delivery, they have industrial buyers who need metal, they have ETFs that have promised their shareholders physical backing, and the only place they can get that silver in the quantities they need is from the COMEX vaults in New York. But the COMEX silver is trapped by the tariff. It cannot economically flow to London. So what happens? London has to bid up the price to incentivize existing holders in London to sell. They have to offer $100, $110, $120 per ounce to get people to part with their physical metal. And as the London price rises, it pulls the New York price up with it because arbitrage traders see the price difference and try to capture it, even though the tariff prevents them from actually executing the arbitrage. This creates what I call a price discovery cascade. The market is searching for the price level where supply and demand actually balance. And because the supply is trapped, because the normal flow mechanisms are broken, that price level is much, much higher than where we are right now. Let me give you a simple analogy to make this crystal clear. Imagine you live in a town with two grocery stores. Store A on the north side of town and store B on the south side of town. Normally, if store A runs out of bread, the manager just calls the distributor and says, "Send me more bread from the warehouse." And the bread shows up the next day. Easy. The price of bread stays stable because supply can flow to wherever demand is highest. But now imagine that the government builds a wall right down the middle of town, and they put a 25% tax on any bread that crosses that wall. Store A on the north side runs out of bread, but the warehouse is on the south side. To get bread delivered, store A has to pay the normal price plus a 25% tax. That makes the bread economically unviable. Store A can't sell bread at a profit anymore if they have to pay that tax. So what happens? Store A just stops ordering bread from the south side, and the people on the north side who need bread suddenly realize that there's no supply coming, so they start bidding against each other. They offer $5 for a loaf, then $7, then $10. The price keeps going up until it reaches a level where someone who currently has bread is willing to sell it. Meanwhile, on the south side of town, bread is still $3 a loaf because the warehouse is right there. You've got the same product trading at two completely different prices in the same town, separated by a wall and a tax. That's exactly what's happening in the global silver market right now. New York is the south side with the warehouse, London is the north side that's running out of bread, and the tariff is the wall in the middle. And here's the critical point. This isn't a situation that resolves itself quickly. This isn't a temporary dislocation that the market can arbitrage away in a few days. This is a structural change that persists as long as the tariff persists. And the tariff is contingent on Greenland negotiations, which, let me be very clear about this, are not going well. I've been reading everything I can find about the Greenland situation. I've been following the statements from Danish officials, from Greenlandic politicians, from US negotiators, and the odds of a comprehensive deal being reached by June 1st, when the tariff escalates from 10% to 25%, are extremely low. I'd put them at less than 30%. Why? Because this isn't just a real estate transaction, this is a sovereignty issue. Greenland is not a piece of property that Denmark can just sell. It's a territory with its own political identity, its own cultural significance, its own population that has opinions about their future. And the idea that you can just write a big enough check and close the deal is naive. The Danish government is facing enormous political pressure not to sell. There are constituencies in Denmark that view selling Greenland as a betrayal of Danish heritage. There are Greenlanders who view any sale as colonialism. And there's the broader European Union, which sees US control of Greenland as a fundamental shift in the balance of power in the Arctic region. From the European perspective, they can just wait this out. They can absorb the economic pain of the tariffs. They can hope for a change in US policy after the next election. They're playing a long game. The US is playing a short game. And when you have that kind of mismatch in time horizons, deals don't get done quickly. So what does that mean for silver? It means the tariff is likely here to stay for months, possibly years. It means the geographic arbitrage trap is not a temporary phenomenon. It means the separation between London prices and New York prices is going to widen, not narrow. And it means that physical silver holders, people who own actual metal that they can touch, are sitting on an asset that is becoming more valuable every single day. Now, let me talk about what I'm watching in the next 48 to 72 hours, because this is where things could get really explosive. There are three key triggers that I'm monitoring closely, and any one of them could send silver significantly higher in a very short period of time. Trigger number one, the $100 breakout. Right now, silver is trading at $94 to $95s. We're only $5 or $6 away from $100. That's a 5% move. In a normal market, a 5% move might take weeks. But in a market that's already in a short squeeze with momentum this strong, we could see that 5% move in a single trading session. And when we break $100, when silver trades with a 1 and 2 zeros in front of it for the first time in modern history, the psychological impact is going to be enormous. Retail investors who have been sitting on the sidelines are going to pile in. Hedge funds are going to start talking about silver on CNBC. Social media is going to explode with to the moon posts. And all of that attention is going to drive even more buying, which is going to push the price even higher. The $100 level is not just a technical resistance level, it's a psychological trigger that's going to unleash a wave of FOMO, fear of missing out, buying. Trigger number two, margin hikes on the COMEX. When exchanges see volatility spiking, when they perceive that a squeeze is forming, they raise margin requirements to force speculators out of the market. It's a standard risk management procedure. But here's what most people don't understand. Margin hikes are also a signal that the exchange is worried. They're a signal that the physical situation is tighter than they're publicly admitting. If I see a margin hike of 20% or more this week, I'm going to interpret that as confirmation that the COMEX is genuinely concerned about their ability to meet delivery obligations. And when the COMEX is concerned, that's when you know the squeeze is real. That's when you know this isn't just a speculative rally that's going to fizzle out. That's when you know we're in a genuine supply crisis. Trigger number three, the London-New York spread. This is the nuclear option indicator. Right now, silver trades at roughly the same price in London and New York because arbitrage keeps the two markets in sync. But if the spread between those two prices hits 5% or more, it means arbitrage has completely broken down. It means the tariff has created a permanent barrier to the normal flow of metal, and it means we're entering uncharted territory. A 5% spread would mean that if silver is trading at $100 in New York, it's trading at $105 or more in London. That's a $5 difference on a $100 asset, which is enormous for a commodity market. And if we see that kind of spread develop and persist for more than a day or two, it's a signal that the system is fracturing. It's a signal that we're moving into a two-price world where physical silver trades at a massive premium to paper silver. Now let me address something that I know is on a lot of people's minds. What about a pullback? What about profit taking? What about the banks trying to smash the price back down like they've done so many times before? Here's my view. Yes, we could see a dip. We could see profit taking push silver back to $90 or even $88. But I don't see it going below that. And here's why. The physical demand is too strong. The industrial buyers are too active. And most importantly, the large holders of physical silver are not selling. Think about it from the perspective of someone who owns 100,000 ounces of physical silver. You've been holding this metal for years, maybe decades. You've watched the price get suppressed. You've watched rally after rally get smashed back down by the banks. And now finally you're seeing the beginning of what you've been waiting for. You're seeing the supply chain crack. You're seeing the shorts get squeezed. You're seeing momentum build. Are you going to sell at 95s? Are you going to take your profit and walk away right before the big move? Of course not. You're going to hold. You're going to wait for $100. Then you're going to wait for $110, then $120. You're going to hold because you understand that what's happening right now is not a normal rally. It's a structural break in the market. And structural breaks don't resolve themselves at $95. The large physical holders are the smart money in this market. They're the ones who understand the supply dynamics. They're the ones who have been accumulating for years at low prices. And they're not selling. And as long as they're not selling, there's a floor under the price. Could the banks try to smash it down with paper shorts? Absolutely, they might try. But here's the thing, every ounce of paper silver they short creates another liability that they eventually have to cover. And in a market where physical supply is trapped and unable to flow freely, shorting paper silver is like digging yourself into a deeper hole. It might work for a day or two, but ultimately it just makes the squeeze worse when they have to buy back those shorts. Let me share with you my personal framework for navigating the next 2 weeks, because I think these next 14 days are going to be some of the most volatile and potentially profitable in the history of the silver market. First, I am holding my physical silver with absolutely no intention of selling. I don't care if silver hits $100. I don't care if it hits $110 or $120. The metal stays in the safe. Why? Because I understand that what's happening right now is bigger than a short-term price move. This is a fundamental restructuring of the global silver market. This is the breakdown of the suppression mechanism that's kept prices artificially low for decades. And I want to be holding physical metal when that mechanism completely collapses. Second, I am ignoring the spot price that you see on financial news networks. That spot price is an average of paper prices across multiple exchanges. It's a mathematical construct that doesn't reflect the reality of what it actually costs to get your hands on physical silver right now. If you call a dealer today and try to buy 1,000 ounces of physical silver, you're not paying 95s, you're paying $95 plus a premium. And that premium has been widening dramatically over the last few weeks. I've been talking to dealers, I've been watching the spreads, and what I'm seeing is premiums that are 15%, 20%, sometimes 25% over spot for immediate delivery of physical metal. That means the real price of physical silver, the price you actually have to pay to get metal in your hand, is already well above $100. The spot price just hasn't caught up yet. Third, I am watching for any headlines out of Greenland or Denmark that indicate the negotiations are stalling. Every day that passes without progress on a Greenland deal is another day closer to February 1st, when the 10% tariff kicks in. And every day after June 1st without a deal is another day under the 25% tariff regime. The clock is ticking, and time is not on the bank's side. Fourth, I am prepared for increased volatility. We could see days where silver moves 5% or 10% in a single session. We could see massive gaps up or down. We could see trading halts. We could see margin hikes that trigger cascading liquidations. This is not going to be a smooth, orderly move higher. This is going to be chaotic. It's going to be violent. It's going to shake out weak hands. And if you're not prepared for that volatility, if you're not comfortable with massive swings in your account value, then you probably shouldn't be playing this game right now. Fifth, and this is critical, I am focused on the physical market, not the paper market. I'm not trading futures, I'm not buying options, I'm not using leverage. I own physical metal, and I'm holding physical metal. Why? Because when the system breaks, when we hit a force majeure event, when exchanges can't meet their delivery obligations, the only thing that's going to matter is whether you own actual silver or whether you own a paper claim on silver that may or may not be honored. Now, let me talk about what the banks are really afraid of, because this is something that doesn't get discussed enough in the silver community. The banks are not afraid of high silver prices. They've navigated high prices before. They can hedge. They can adjust their books. What they're afraid of is a market where they can't move metal to where they need it. The entire fractional reserve system in precious metals, the system that allows the banks to sell more silver than actually exists, depends on geographic flexibility. It depends on the ability to shuffle metal around the world to wherever the pressure is building. When London gets tight, metal flows from New York. When New York gets tight, metal flows from Zurich or Singapore or Hong Kong. It's a global shell game, and it only works as long as the shells can move freely. But the tariff has locked down one of the major shells. New York can't ship to London anymore without taking a catastrophic loss. And that breaks the entire game. The banks can't play whack-a-mole with physical shortages anymore. They can't suppress prices by moving metal around. They're trapped. And when you trap a fractional reserve system, when you eliminate its ability to shuffle inventory, it collapses. Think of it like a bank run. A traditional bank might only keep 10% of deposits in the vault. The other 90% is loaned out. As long as everyone doesn't ask for their money at the same time, the system works fine. But what happens if everyone shows up at once demanding their deposits in cash? The bank collapses because they don't actually have the money. That's what's happening in the silver market right now. The LBMA has made promises to deliver physical silver. They've sold contracts. They've backed ETFs. They've created paper claims on silver. And they did all of this based on the assumption that if they ever needed physical metal in a hurry, they could just call New York and have it shipped over. But now they can't call New York. The phone line has been cut by a 25% tariff, and all of those paper promises, all of those delivery obligations are coming due at the same time, and the vault is empty. The LBMA is facing a bank run in slow motion, and there's nothing they can do to stop it. This is why I believe we're going to see silver trade above $100 this week, not because of investment demand, not because of inflation fears, not because of dollar weakness, but because the LBMA is going to have to bid up the price to astronomical levels to incentivize existing holders in London to sell their physical metal. They have no other choice. They're trapped in a corner, and the only way out is to pay up. And here's the beautiful part. As the London price goes up, it pulls the New York price up with it. Even though the metal can't physically flow from New York to London because of the tariff, the price discovery mechanism still links the two markets. Traders see silver at $110 in London and $95 in New York, and they start buying New York contracts hoping to capture that spread, and that buying pressure pushes the New York price higher. So we get price convergence without physical convergence. The prices move closer together even though the metal can't move. And that's how we end up with silver at $100, $110, $120 or higher across both markets simultaneously. Let me conclude with this. We are living through one of the most extraordinary moments in the history of precious metals markets. We are watching the real-time breakdown of a suppression mechanism that has been in place for decades. We are watching geographic barriers create pricing anomalies that shouldn't exist in a modern globalized market. We are watching the laws of supply and demand reassert themselves in a commodity that has been manipulated and controlled for far too long. Silver at $94 today is not expensive. Silver at $100 is not expensive. Silver at $120 is not expensive when you understand the structural impossibility of the current supply chain. The tariff has created a trap. The banks walked into that trap, and now they're paying the price. If you own physical silver, hold it. If you've been thinking about buying physical silver, understand that the premiums you're seeing today are likely the cheapest premiums you're going to see for a very long time. And if you're trading paper silver, understand the risks you're taking. Understand that this is not a normal market environment. Understand that the rules are changing in real time. The 14-day countdown to February 1st has begun. The tariff is coming, the trap is closing, and silver is going higher. This is not speculation. This is mathematics. This is logistics. This is reality. Stay sharp. Watch the data and trust the fundamentals, because what's coming next is going to shock the world. Think of it like a bank run. A traditional bank might only keep 10% of deposits in the vault. The other 90% is loaned out. As long as everyone doesn't ask for their money at the same time, the system works fine. But what happens if everyone shows up at once demanding their deposits in cash? The bank collapses because they don't actually have the money.